So many factors have been thought to be the reason for the steady decline of jobs in the US and Canada, and although the US has recently been seeing an improvement in that sector, the Canadian economy, however, shows a sharp decline in jobs, but a steady unemployment rate, which implies that while there are fewer jobs available, there are also fewer people looking for jobs. It's important to note, however, that despite the decline, the jobless rate held steady at its record low of 4.9%, implying lower participation in the labor force. It is worth noting that the labor force participation rate is still rebounding from a lower level during the COVID-19 pandemic. As governments introduced various support measures at the beginning of the pandemic, starting in the second quarter of 2020, the share of households with benefits, non-pension, benefits as a main source of income reached 15.8%, while the share of those who primarily earned wages and salaries dropped to 59%. Following the expiry of most pandemic support measures at the end of 2021, the levels moved closer to pre-pandemic rates, at 4.9% for those with benefits, non-pension, and 69.6% for those earning wages and salaries as a main source of income. Would there be any increase in the job sector in the coming months? Don't forget to hit the like button and subscribe. Canada's economy unexpectedly lost jobs for the second month in a row in July after a year-long boom, but analysts predicted that this would not stop the Bank of Canada from raising interest rates to fight inflation. Statistics Canada on Friday reported that 30,600 positions were shed while the unemployment rate stayed at a record low of 4.9%. The data marked the second consecutive month of relatively moderate losses. Between May 2021 and May 2022, the economy added 1.06 million jobs as the recovery from COVID-19 took hold. Analysts polled by the Reuters news agency had expected an increase of 20,000 positions and for the jobless rate to edge up to 5%. The central bank last month surprised markets by raising its main interest rate by 100 basis points in a bid to tackle inflation, and said more rises would be needed. Derek Holt, Vice President of Capital Markets Economics at Scotiabank, said the July figures were disappointing but predicted Canada's central bank would keep raising rates. I think they know full well that fighting inflation is going to break a few things, and one of them will be slowing job market momentum, he said. The average hourly wages of permanent employees, a figure the Bank of Canada watches closely, rose by 5.4% from July 2021, down from June's 5.6% year-on-year increase, but sharply higher than the 2.4% registered at the start of the year. That's going to concern the Bank of Canada much more than the job count as evidence of tight markets amid difficulty getting workers, said Holt. Some statistics show there was no indication of increased job churn despite the tight labor market. The United States, by far Canada's largest trading partner, on Friday reported unexpectedly strong jobs numbers, which helped push the Canadian 0.6% lower to 1.2945 to the greenback, or 77.25 US cents. The Canadian Central Bank's next scheduled rate announcement is on September 7th, with the August jobs data due on September 9th. Money markets have fully priced in a 50 basis point increase and see about a 2/3 chance of a 75 basis point move. We're still dealing with the lowest unemployment rate in at least 50 years, and wages that are running strong, said Doug Porter, chief economist at BMO Capital Markets. I believe things are nearly weak enough to call a halt to rate hikes. We had penciled in a 50 basis point rate hike in September, and I would say we're comfortable with that call, he said by phone. The Bank of Canada on Wednesday, July 13th, raised its main interest rate by 100 basis points in a bid to crush inflation, surprising markets and becoming the first G7 country to make such an aggressive hike in this economic cycle. The central bank raised its policy rate to 2.5% from 1.5%, its biggest rate increase in 24 years, and said more hikes would be needed. Economists and money markets had been expecting a 75 basis point increase. We had indicated we were prepared to be more forceful. Today was more forceful, Governor Tiff Macklem told a news conference after the decision. Yes, it is a very unusual move to increase by 100 basis points at one decision, and that reflects the very unusual, exceptional circumstances that we find ourselves in. Earlier, the central bank said excess demand, high inflation felt across sectors, and rising consumer expectations of persistent price gains prompted the supersized hike. which lifted the policy rate to its highest level since 2008. In its July forecasts, also released on Wednesday, the Bank of Canada said it expected inflation to rise further, saying it would remain around 8% in the next few months. Canada's inflation rate hit 7.7% in May, near a 40-year high. The central bank now sees inflation averaging 7.2% this year, falling to about 3% by the end of 2023 and then back to the 2% target by the end of 2024. The Bank of Canada has been playing catch-up with hot inflation for months, prompting rare attacks from critics and fueling worries that Canadians could lose faith in its ability to contain prices, leading to price spirals. Our forecast is for a soft landing. As I said, the path to that soft landing has narrowed, said Mackle, who participated in the decision remotely after recovering from COVID-19. And that is an important reason why we took stronger action today to front-load policy interest rates. Still, the 100 BP move coupled with a warning of more hikes to come could spook markets, said economists. The market is going to be on edge here about the possibility of more upside surprises on rate hikes. The policy rate is now at the nominal neutral rate, the midpoint between 2% and 3%, where monetary policy is neither stimulative nor restrictive. The slower growth is largely due to the impact of high inflation and tighter financial conditions on consumption and household spending. The Fed knows full well that fighting inflation is going to break a few things, and one of them will be slowing job market momentum. The average hourly wages of permanent employees, a figure the Bank of Canada watches closely, rose by 5.4% from July 2021, down from June's 5.6% year-on-year increase, but sharply higher than the 2.4% registered at the start of the year. We would be watching the reports for August to know if there have been any improvement in the job market or if we are still caught up in a cascade of spiraling free fall in our labor market. To endeavor not to miss any update, click the subscribe button and don't forget to like this video and drop your comments below. Thanks for watching.